Good day and good morning to you. This is Will Scheier, and thanks for the introduction, Justin. Appreciate it very much. Always good to be back with Ninja Trader. This is, I think, the fourth one I've done for you guys. I'm ValhallaFutures, and this is E-mini trading methods. We're going back to the old school. Let's get started. Before we really begin, the CFTC would like you to be reminded of a few critical things. That the risk of loss in trading commodities can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition. I'd stress also you should consider whether it's suitable for you in light of your current training. Do you know what you're doing? For instance, I never take trades unless I'm using OCO orders. That's automatic trade management orders. OCO means one cancels the other. So when I get a fill, my stop order and my target are already placed. Now they're away from where I may end up taking the trade. That's irrelevant. But they're already in the marketplace, so I can move them with just one click. High degree of leverage. It works both for you and against you. If you have a trading plan, volatility is an amazing thing. If you don't, it can work against you very quickly. Disclaimer: past performance is not indicative of future results. All results are hypothetical. There's no implication being made that anyone utilizing these methods described herein can be assured of similar results. I'm fascinated with this because it is so true that two traders using supposedly the same methodologies can come up at the end of the week or the month with entirely different results. And I believe this states my point and my argument. You can go back to webinar number 3 off my website where I go into it more detail, and it's also covered in my book. I'll talk about in a minute. That the real secret to success in trading is not the methodologies. It's independent of that. It's having a precise trade entry models that you use at the right edge of your video screen regardless of your trend prejudice, and that you avoid using intuition and tape reading in order to make those trades. And we're also not recommending you buy anything today, specifically buy or sell any particular commodity, futures, or stock, or anything else at any particular price. That goes without saying. There's also something I call CFTC omissions. I made this up. It's a bit tongue-in-cheek, but I actually think this is as true as the warnings they give you. Vendors selling snake oil are just as likely as the markets to take a good piece of your money away. Not only because they might sell you something that costs you a lot of money that isn't any good, but that you might be convinced of its utility and lose a lot of money working with it. Sorry to say, it's a sleazy world out there now. And that trading without a well-prescribed and specific trade entry and management plan will almost assuredly lead you to losing all your trading capital. Now that was said as if the CFTC really said it, but of course they didn't. In my opinion, that's really the biggest threat. Something they didn't even mention, so I call it CFTC omissions. Who am I? Why am I here? Why would you bother wanting to listen to me? All good questions. I don't know if I can ever give you the answers. I've been at this a long time. That's what that says. That's not really accurate. I'm older than that. I'm 64 years old now. I got started in 1979, although I wasn't really doing all that kind of stuff then. I was basically learning myself, and I got started as a broker, mentoring with a guy who was already retiring. In fact, he was retiring within a few months of the time I started, but I spent a lot of time with him, and he's actually described in the book Old School, a cotton trader, and you really have to know your stuff in the cotton pit. He traded from the pit, and I learned so much from him. I'm an author of a book now. I used to use the basis of this book for my trading course. My trading course is fairly expensive. It's $3,000, but the book's only $50. Not everything I've discovered is in this book, but a lot of it is, and it can be very handy for you. You can find out more information about it if you want by simply going to my website and clicking on books and software, and you'll get a page that lists all the vendors should you want to check it out. It's not very expensive. Cheap way to take a course, actually. The book does not include all my original trade models, brand name setups with copyrights, because I've uncovered something called serial sequence in order to replace and make work an assumption that Elliott Wave actually taught me, and that is there is an internal structure to the market. I swear there is, but I couldn't make Elliott Wave work. The market will not be constricted and force-fit into 5-wave impulses, because suddenly there's a 6th and a 7th and an 8th. And you're just getting stopped at endlessly. But there is an internal mathematics that does call the end of fractal patterns with amazing accuracy. I'm proud to have uncovered it. I don't give that away for free, but it is part of what I've brought to the table. I created a track record on this with the other things that I use when I put them together to make trade entry models, and that track record is created in a real-time chat room. They're time-stamped. All my trades are time-stamped, and they're recorded every day, actually, in a daily blog. If you go to my daily blog and click on my post on my trades, and I also scold myself for having failed my trade plan. I used to write things about technical analysis in my journal. That's a waste of time. If you're going to create a journal, then create that journal based on whether or not you have, in fact, kept up with your trade plan. That's really what it's all about. You can also see in performance what I've done for the past few years. And unbeknownst to me at the time, some people from this magazine, or who wrote articles for this magazine, came into my room for a number of months and documented all my trades. And they did this over the course, a few months for my room, but of course over the course of about 4 years, they documented some 512 trading rooms. Is that even credible? I didn't even know there were more than 10. I had no idea. In any case, I'm proud to say, I guess, that I don't know anything about these people, so I hope they're not on the room, because I've never actually read Futures Truth magazine. But in any case, I was rated top 10 of all those rooms in my trading room. I'll show you how you can visit it for a period of time. Currently, I'm using it to train. I run a course from there, but I open it up to the public occasionally. I do have this all-inclusive training course if you really want to stand on your own and be independent and trade with self-reliance from the right edge of your video screen. That article in Futures Truth seemed to assume that everybody wanted to just stand on somebody else's shoulders and take their trades. I've never been able to do that. I always want to know, how do they know that? But apparently some people don't care about self-reliance. They think they can just go to school on somebody else indefinitely. I would disagree, and I would not want that for myself, but I'll let you decide what kind of a person you are. Student testimonials. My website has some. Also at the brokerage firm of Interactive Brokers, where I'm a tutor. I'm a authorized preferred educator, and I fall into that category with Ninja Trader as well, who sponsored me today, as you know. What am I doing today? Today's deliverables. Well, we're going to talk about Fibonacci. Is it true, or is it Pinocchio? I understand those two people are actually from the same town, interesting enough. Fading the gap was a big vendor ploy, should I say? Or should I say just method and be nice? I'm going to talk about fading the gap a little bit, or versus baiting the trap. So we'll talk about that as a subject matter, give you some alternatives. Remember, this is a trip back to old school. I'm also going to show you how to port all session technicals into day-only session. you can get such great information by studying all session stuff. Even though I'm applying old school methods to all session trading, without computers we never could have done this. So there is a bit of mixture between new school and old school. I'm guilty of all that. And we'll talk about how you can get into my chat room, give you some free coaching, and I'm going to give away about 5 books just by doing a little drawing or whatever later on. If you want to take note, you'll have to send me something when I show you to will@ValhallaFutures.com. Easy to remember. My name is Will. Fibonacci or Pinocchio. I say that somewhat in jest. And before I, dump on these great brand name concepts, and I know some of you really worship, like some of the vendors who market this stuff at the altar of sacred science and consider Fibonacci sacred science. And I sort of feel like I had to begin by a confession. I sort of feel like I'm at an AA meeting. Hi, my name is Will. Hi, Will. I'm a recovering Fibaholic. I used all this stuff too. I bought all the expensive software. I combined Fibonacci with Elliott Wave, and I tried to succeed with it like everybody else does. And I found it so inconsistent that it finally I gave it up. But I went to a seminar recently from a protege of one of those people that I bought a lot of expensive software from, and I thought, well, that'd be a good thing just to re-give their little webinar example. So that's where I'm going to begin with this. I want to talk, eventually come to a conclusion with this presentation of this little Fibonacci trick. I want to compare what I'm euphemistically calling sacred science of Fibonacci. I mean, it's like politically incorrect to criticize it. So, excuse me, versus classic old school price history. And so I'm just revisiting a webinar that I went to myself. And we won't remain nameless. This is a very nice person, probably more successful trader than I do, so what do I know? But they were using this particular stock chart, and they were using to try to determine where to buy using some Fibonacci methods. And you've probably seen all this kind of stuff before. The 62% retracement is kind of a key number, and they take a grid over, and they sort of take from the low and the high, sort of cherry pick that, but that's okay. We'll stick with this for a while. And from this high coming back down, assuming that the trend is up, they might look to buy at the 62% retracement, so which hasn't occurred yet, but it creates this line over. And they like to do this stuff in clusters because clusters are better than one. It's sometimes debatable, but that's okay. We're going to go along with this. This was the Fibonacci extension. So rather than a retracement, we've had a swing here, and the extension of 1.272 is a popular number for Fibonacci, and you can see that the lines somewhat correspond. So we have a beginning of a little bit of a target. And then they took what's called a measured move, this distance right here from here to here, and they duplicate that, so equidistance. They call this Fibonacci, but it's really kind of old school. And so that the swing would be in equidistance down. That goes off the page, so I'm just going to bring this over to Marcus and then bring it back so that we can see where that goes. And lo and behold, it's also about the same place. And now we have a target. So we'd be interested in buying there on theory, and all that to show that a few days later the market opened near that level. And consequently, the person put a buy stop above the high of this. These are not my methods, by the way. I don't use that kind of a method, but that's okay. I'm just going along with this. And I just accept it all. It's pretty neat, I guess. But then this is where they lose me, because at this point they said the Fibonacci is delivering points of entry that no other technique can deliver. And that one really got me, because I'm sitting here like you are and staring at this huge gap, wondering, now what is really making the market move? Does it sense it's at a 62 Fibonacci level or a 1.272 or a measured move? Or is it instead reacting to a gap? let's take a look at the history of this one, because they have the audacity of using this particular chart. So I'm not straying from their own choice. And look at some of the others, because this particular chart is riddled with gaps. And if I were to apply the 62% retracement level to this swing down here, it didn't work. Maybe something else did. 50 didn't either. 38 is up here. So I don't know, but it didn't. But I can see that the market's doing something similar. And I can see that there's a gap here. We'll come to the difference between fading a gap and baiting the trap. But let's just give the definition first of baiting the trap and say, go along with all the people that tell you gaps, some percentage of gaps close. I'll go even farther. All gaps close eventually. I mean, if the price has the history of a rally and an eventual collapse, probably every gap on the board will probably close eventually. So what am I interested in? Am I interested in fading it or baiting it? In this case, just playing against the gaps looked like to me to be the spur of the market repeating itself. And this is an easy old school phenomenon to acknowledge. You don't know how far the gap's going to close, and a trick I use, and I do this every day, is that when lows that have preceded a gap, there's a low. This is all the open gap. When that low starts to close, and it's not going to close until, let's say, the next bar, I put a buy stop as it's taking out the low. I may gap down if this is a daily bar. If it's not, then it could sell down hard. But if it breaks this low, then I want to put a buy stop just above. Maybe the body of this candle. In this case, it's so small I could go clear up above the high. But when I'm down here in the lower 3-minute bar frame of trading E-mini futures, I can use one bar, or I can use even smaller than that. I certainly wouldn't use a daily bar. So that once, I didn't want to quite go that far, once this breaks the low, if it is repelled by the exhaustion of breaking a low, because that's what usually happens, this is exhaustion, breaking a previous low, I'm picked up. I usually trade 2 to 3 contracts. I exit one very quickly in the E-mini. I trade the Russell. I'm out with 5 ticks, and then I put my stop 5 ticks to 7 ticks on the other side of it, trying to reduce myself to net break even. And after that, I'm pretty dangerous. It doesn't really matter what the market does. I have nothing to lose. I'm not predicting the whole gap will be closed, but I'm baiting the trap. And as a matter of fact, over here, when that person was buying this gap was filled essentially at the opening. And that, notice that it came back to the previous high, didn't actually close the full technical gap. Very typical. So if the market opened down here and it was accomplishing this, then I'd simply put a buy stop above it. Get filled and see if I could partial out. If it kept going down, then if my partial out should have paid for my trade. If not, then I'm subject to a loss. Notice that that same thing that I just showed you here actually occurred up here. Let's get this old school out of here, new school out of here, the sacred science. And that occurred exactly as I'm showing you right here. Dipping down into the gap and taking out that low was enough for this market to act sharply, coming back up. So as the market's falling, I put a trailing buy stop, and I see if it'll come back and get me. Simple technique. I use it every day. Let's look at a few other of these gaps, because once again, the supposition is that Fibonacci was the only place to trade off this. Let's go back in history a little bit. Here's one here, and this is a gap down, and it came back up, filling the gap, and then you trade in the direction that the original gap went. Here's a gap up, and it comes back to fill the gap, and you trade back in the direction that the original gap up. And this gap we've already talked about was here, and that produced a substantial rally. So it seems to me, if I'm going to make any kind of a conclusion, and not only is it in this chart, but if you go back and study gaps, you'll see this happen all the time, and I'm going to emphasize that in a minute. That the supposition being that the Fibonacci offers you trades that you can't find anyplace else, I want to flip that all the way around. Trading old school, just trading around gaps, shows you many entries that Fibonacci could never find. Fading the gap? Well, we weren't fading the gap there, were we? We weren't expecting the gap to close right away. We were doing something else. We were baiting the trap. These are just some figures I did studying the June contract last year while I was writing the book, trying to emphasize this point. Just using the 90-day look-back period, I summarized all the gaps of 2 points or more in the E-mini Russell. Now, gaps sometimes occur a few ticks either way. You sneeze and they close, so I don't want to go to school off those because I couldn't really trade or draw conclusions off them anyway because the market is sometimes vacillating right in the open. But there were 39 total gaps of 2 points or more during this period of time. Of those gaps closing in the initial trend, let's go back to that's what I'm talking about here. Expecting, and this is what vendors often taught. I've been in so many rooms when they used to do this. In fact, I was hired once to call futures in a stock room. And I got in there, and these guys were just fading the gap every day with stocks. The market would open, and there's a gap here, and they'd go, well, it's got to close. And they'd wait 5 minutes, 10 minutes. They had some kind of a filter or whatever. And they asked me, are we going to fade the gap in futures? I said, I'd rather keep my money, thank you. So fading the gap is the expectation that the trend will close immediately. Baiting the trap is simply waiting for it and taking the trend, in other words, in this case, shorting, expecting to cover as it closed. That's fading the gap. Baiting the trap is waiting patiently, not even waiting patiently, just keeping an eye where the lows and the gaps close, and in the eventual process that it does, in this case many days later, consider taking the trade back in the direction of the gap. So gaps closing in the initial trend were only 6 out of 39. It's 15%. That's no good. Gaps closing the same day were 9 more. That means later the same day, maybe after some excursion in the direction of the initial gap, the gap eventually closed. Now let's assume that you had a really wide stop, or you somehow figured out what the eventual excursion was and then got your entry there and rode it all the way back down to the gap. Those are pretty big ifs, and those aren't so easy to do, anticipating that the gap was going to be closed. That's after a gap and go exclusion. Gaps closing after 2 days were another 11 of the total 39 gaps, and gaps closing after 5 days were another 13. You can see how long gaps takes to close, and then gaps still unclosed after 30 days. There were 5 more. Total unclosed gaps for the initial trend were 33 out of 39. That's how many if you just went with a gap and go trade. As soon as it gapped up, you just went with it and bit your tongue. The opposite of what was being taught by these vendors who were constantly fading the gap. Your actually percentages were a lot better. Let's look at baiting the trap. What does baiting the trap mean? Remember, I didn't fade the gap expecting it to close. I simply waited and kept an eye on these price levels, and when price eventually came back there, I was waiting to take the trade against the gap. Let's look at the same numbers. The 90-day look-back period, the total was 39. Trend reversals at closure. Of those 39 gaps, when they eventually returned, no matter how long it took to return, 21 of the 39 reversed immediately and went back in the direction of the gap. That's a pretty high percentage. Small bounce only were another 6, and that netted me a break even. In other words, it hit the gap and bounced, but you only could partial out so much. Maybe it moved a point, or even for me, only has to move a half a point. No reversal at closure at all were 8. And that also assumes that you didn't wait at least 1 minute just to see if it would. Because sometimes the market comes crashing down and it's not ready to turn yet, and it trades through the gap closure. Sometimes it's very violent. You can use just a little bit of observation and give it a second to see if the market has slowed down on reaching it, or it's just coming crashing down, and you might not have to take as soon as it hits the closer anyway. You don't have to be totally stupid about this trade. But the total favoring trade entry were 27 out of 39. You at least got to break even. What would you rather do? Would you rather bait the trap or fade the gap? Okay, moving on. I got to keep this moving. I'll answer some questions later. This is pretty simple stuff. It's old school, but it's contrary, unfortunately, to what many of you are actually being taught in rooms. All session technicals into day-only session charts. What is this all about? This is the wisdom of the old school trend lines. But it's trend lines being pulled from all sessions. The magic of computers that we have all session, and we're trading almost 24 hours a day and all this stuff. I want to show you an example. I use this every day. This is the TF chart, my drug of choice. If you're not trading the TF yet, boy, are you missing some great stuff. These are simple trend lines being drawn. I just eyeball them. There's no magic here. And they're approximate because they don't always add perfect. I do not use breakout of trends to take trades. I'm using this as support and resistance. I sell short into this if it also matches the structure that says, in a momentum gauge that says it should be topping out. I'm buying into the lows. And we'll just go back through history a little bit. You can see that it's not quite perfect. It never is. But some of them are deadly accurate. Look at these string of highs being contained before a crash here. That's a channel. I'd like to come back to that because I talk about that in the book. Going back a little bit farther, you can see, here's a good example of why I don't take them by breaking. Here's one that broke cleanly. I couldn't predict that it was going to be just a small spike, but once it did, it came back and retested it. That's what I look for when a line breaks. I don't go after the break. I wait for the retest, which is actually fairly typical. Here's one over here, big sharp break, but it retests. If you're patient, these are 60-minute bars, so it's a few days, but that's basically a gap closure. Just be patient. It'll probably come back and retest it. But you can see otherwise how brutally accurate some of these can be. This is all session E-mini. I've had people in the room going, how does he know where that thing's going to top out? I keep telling people, look at your 60-minute all session. I don't even hide this. It's not magic. There's no Fibonacci involved here. But if you're not doing this, then you're missing out on a lot of important trend information that is so valuable to trade. I just keep it going all the time. Keep it going all the time. Lows are also critical. I want to show you a little bit about lows, and I'm going to show you how to port this into your day session only charts. That line got deleted. This low is taken out by this low, just fractionally. Did it keep going? No, it reacted. Try to get in sync here. This low right here was taken out by this low. Did it keep going? No, it reacted. This low was taken out by this low. Now the trend is clearly down here, but I wouldn't want to short on that break. And yet I've been in rooms where people were shorting break based on lows being taken out. There's almost always an initial reaction of taking out lows. That's 15 points. That's a day's worth of trading. Those are 60-minute bars. I don't want to short breaking that low. Ouch. Here's a low. It's taken out. There's a huge bounce. This is we'll come back to that in a second. That's why it's so important to know where lows are. And we'll show you from the previous thing how important it was to know where gaps are, right? Because gaps tend to bounce as well. So this is all old school information, and we're going to port it over into new school charts. This was a channel. I go into the channels in the book quite a bit because channels will form in your intraday trading as well. And this is just a tool you use. It's like a Fibonacci tool, really, but it's not Fibonacci. It's just 50% retracement, old school stuff. Nothing Fibonacci about that. And you can set the indicator to set up this as a default. And I just eyeball the 50% of that, like so. About there, I'd guess, someplace around there. Just looking at the channel, someplace in the middle, and then I just let it go. And before this channel broke, I said, if this channel breaks, I was in the room, I said, there's our target. And I didn't know if it's going to reach or not, but it did. And they're not always that accurate. I don't pretend that they have to be. This is old school stuff. Notice the trend lines, how accurate they were until they broke, this low being taken out. Eventually this channel broke out, and notice what it did here with this low. Initially, let's clear over here, let's say intraday low, all session low, it occurred at night. It didn't have that reaction. Now that's critical, because the fact that it didn't means now I treat this low as slightly different than I treated other lows. The fact that it crashed through it means most likely it'll probably come back. It's taking out another low here. It'll come back to it and revisit it as resistance. And I use that number to call a short that day. Not just because it got there, because there was a structural thing that said the market should be topping out in that wave structure. It didn't tell me how far it's going to go down, but it's a big sell-off, as it turned out. I'm not trying to take 10 points per trade. These are 60-minute bars. I'm trading in much smaller frame, but you can see how important these lows are, these trends are. This is all market structure and market history. No Fibonacci involved. None whatsoever. And yet this stuff is deadly accurate. And I want to port that into my all session price, day session only pricing, because this is the world that I live in over here. Why am I trading here instead of all session? Because I need to know where the gaps are. This is a gap chart. I need to know where the openings are, the opening each day and the gaps of previous history. Knowing where the opening are is critical information. And it's called the ORB, the opening range bar. I made that up. There's no such thing as the opening range bar, but there is something called the opening range. And you can get that from previous webinars from a website. Webinars 1 and 2 talk about it quite extensively, and it's also in my book. So I need to trade in here, in this world. But I need to know what's going on in here, translated over there. For instance, this trend line right here, it's right here. And how do I get it to appear? It's real simple. NinjaTrader provides you this. You just right-click on the line and hit Properties, and it allows you to attach it either to the chart that it's in, which is just the 60-minute all-session chart. And if I did that, or I trade it to all charts, it'll appear in the same contract every place else that there is such a contract. You can make it disappear by hitting it back, just applying it to this room, and hit Apply, and it disappeared. For instance, this low is very critical to me, but that's not a day session low. These are my day session lows here. Hasn't been taken out yet. Here, hasn't been taken out yet. These red lines are my gaps that have not yet been taken out yet. I want to know where all those are, because really important things in the market are going to happen around structure. Not Fibonacci, but structure. And this is about 1140. And right now, for instance, if I go down there, I don't actually have that number appearing at 1140. I have some others, but I don't have one appearing at 1140. And I do that by simply right-clicking and changing this to Properties to Attach to All Session, and it appears 1141. It's a slightly different style, so it tells me it came from all session rather than these, which were day session only. The history of the market structure is projected across here. It tells me what date that they occurred from and what price level. This is not provided to you by NinjaTrader. It's a pivot and exhaustion grid, and it's described in detail in my book. And if you want this to be automatic, why, you can buy a programming package from us for $250. It's not very expensive, really. You can read about it in the book, and you can keep up these lines yourself. If you can keep them up yourself. It can be rather tedious. But I want to know where the history is. I want to know where the history of all the lows and open gaps that have not yet been taken out, and I want them to be automatically taken out as soon as they're touched. End if touched is a preference in our programming. Otherwise, you have to manage all this stuff yourself. And these other orange lines come from a different type of market structure. It's called a pivot ledge or a breakaway lap. We also have dynamic support and resistance, and it's all included in that package. I don't just trade off numbers. There are vendors who say that's what the market is about. It's really just a drift at the mercy of the news and the efficient market theory. I postulate that's absolutely false. But they're only trading off numbers because that's all they understand. I use the numbers as backdrop, and I'm really looking at wave structure, which is really a fractal structure, and it's called serial sequent. And that combined with this can give you target accurate trade entry models and give you self-reliance, so you don't ever have to be standing on anybody else's shoulders. But that does involve a lot of training. It also involves another piece of software. This is inexpensive. Serial sequent and 10 weeks worth of training is not so inexpensive. It's $3,000. But you can look at the book, and I'm going to show you how you can come into my chat room and look at some of this stuff a little bit closer. And just getting this information from the book can hopefully improve your trading. As you can see from the history, old school, not new school, market structure is probably where most likely the turns and trades are going to take place. Okay, first deliverable. I enjoy talking to traders. All you got to do is send me your Skype nick. If you're international, don't send me your landline number because I won't call you. But national, I can call you back free from my Skype. And if you're not using Skype already, wow, it's free. And it's better than quality than landline or cell phone. It's amazing. Don't know how the phone companies are staying in business. Just send me an email, put coaching session in the subject. Make sure you put your name in there. And I put you down on a list. I get 10 of these a week, and I put them down on a list, and I get them back at my own convenience. It's not about selling you anything that I have. It's about you talking about where you are and me perhaps giving you some ideas about where you might go next. I'm trying to be of help. Mentoring is critical, especially for those of you who are just beginning. If you want free attendance in the chat room, although it's a private chat room and it's currently being used for the students who are trying to learn all this stuff, I open it up occasionally for a couple of weeks. And when I do open it up in a couple of weeks, I'll send you a link. Just say chat room and please give me your real name and choose a nickname, no spaces, 5, 6, 7, 8, 9, 10 letters, whatever you want. Send it to will@valhallafutures.com. I'll send you the link to get in there. And I'm giving away free copies of the book. I've got about 5 of them that the publisher gave to me, and I don't know how to do this any other way, but send me a number from 1 to 100. And I'm going to have somebody at NinjaTrader send me a number from 1 to 100. I'm going to use theirs and run an algorithm on it so that they don't know what it is. And the people who are the closest, the 5 people closest to that number, I'm going to send you back an email saying, congratulations, you got a book. If you're not U.S. and you're in a foreign country, you get a digital copy. That's the best I can do. will@valhallafutures.com. And I might have time for just a few questions now that I've rushed through this just a bit. Do you have any?